So I can see your screen.
Yeah.
Right? Yeah,
Which I've just done it
exactly.
myself. Yeah.
Yeah.
Yeah. So we've got a new person, Joanne Lee. Hi, thanks a lot for joining us.
Evening, how's it going?
Very well.
Well, actually, it's a difficult time in the market for yours truly. Had a very bad year. Obviously, I've got into government bonds in big size way too early, and lost me a lot of money. So, not feeling very clever at the moment, frankly.
Yeah, my condolences.
Yeah. Not much fun. I mean, frankly, I've made a lot of money out of the markets over the years, and I take a lot of risk, and sometimes it blows up in your face. And
Yeah. Well, they're index linked, aren't they? So
yeah, they are. Yeah,
you're not really
exactly.
losing in a particular sense, So losing a bit of capital, it's.
Well, the thing is, if I can actually hold them to maturity, I have to be very old to get them to maturity.
Well, with inflation at 9%, I mean, people are losing capital anyway, aren't they? So
Well, that's right. I mean, the thing is that this is a cyclical trade, and I think that when the economy turns down, the Bank of England will have to cut rates hard. That's it. Now, in the weekly, which I'm going to record tomorrow night with Richard, I mean, if you look at the latest US data, I mean, inflation in the US is actually running at about 1.5% if you use rents, like live rents, as opposed to the Fed's, owner equivalent rents, which we know have huge lags in them. So I really don't see what the big concern about inflation is, honestly.
I think it's because they're doing so much on the fiscal side, So the monetary side, they're tightening, but the fiscal side, they've got a lot of spending programs with the Inflation Reduction Act, which is the opposite of what it says. And it's just, I think there's a tweet by Florian Whitaker, and he basically outlines all the spending on the fiscal side, and it comes to quite a few percent. I can't recall what exactly, maybe 3% or something, and it adds to the GDP. So nominal GDP will still be good on the income side. So even though in the private sector businesses are clearly suffering, and you can see that through the PMIs and all the indicators that you track, and the money supply is going down, M2's going down, but on the fiscal side, it's running a fiscal deficit of 8% of GDP. The US. So in nominal terms, a lot of money is being pumped into the economy.
Yeah, no, I agree with that, Musselwhite. But I would also say that I've seen, and I don't know quite how much to believe this, but data showing that the Inflation Reduction Act, not much of that has actually been spent. And I really wonder about how big the fiscal deficit is, given we know that there's a lot of tax revenues which have been deferred. So in the case of California and Georgia and Alabama, they were given an extra 6 months to file their 2022 tax returns. And I just don't know, is the bottom line. Don't know how much of California has taken advantage of that, etc. I mean, so I suspect that the fiscal deficit looks worse than it actually is. And we certainly are going to get some tightening in October when the student loans need to be repaid. Plus the fact that, there's now the markets are pricing in an 80% chance that the government shuts down next week. And, who knows what the deal is going to be. The latest I've read is that the the Democrats have proposed a deal, and Republicans want to cut the deficit, but they're refusing to consider higher taxes on the rich. They just want to cut spending on the poor. So that's not going to. The two sides quite a long way apart.
And you could argue there is no real constraint on their spending anyway. Both parties just want to, they're not going for a balanced budget. Let's put it that way.
No, that's true. But the other thing is, when people talk about, the increase in the number of US treasuries being issued, which is absolutely true, is enormous. But every single auction is more than covered. And they're not having failed auctions. There are buyers of this.
Yeah.
And if you look at the the flows, you'll see that there have been big flows into US government bonds from households. So these yields, they're very attractive. So of course people are buying them. So I don't really understand what's going on. I mean, frankly, the other thing I really notice about bonds is they are behaving like risk assets. So rather than safe havens. So when the stock market sells off, bonds sell off.
Yeah.
And it should be the other way around.
Normalization. I mean, aren't we in an era where things are just getting back to normal without the QE, without all the bond buying by the central banks, and things are just rewinding to a more normal level, and that would be, maybe about 5%. I mean, I hear that a lot of bond experts like Bill Gross, they are saying that there's still no term premium in the 10-year bond. So that's a sort of risk premium, like a stock market risk premium for the bond market on the duration. And they're saying it still needs 1.5% basically. Or around here, they say bonds are not too bad. They're more reasonable, but they're not bargains on the 10-year.
Yeah, so I disagree. I could disagree with that because, I mean, the thing is, the bond market, that is true if he believes that current interest rates are sustainable.
Yeah.
If current interest rates are sustainable, then yes, obviously you should get a term premium for holding longer duration. But, I just don't think the US economy can live with interest rates of 5.25 to 5.5%, going forward. The bottom line is that a lot of US households just haven't experienced those higher rates yet because of their mortgages. But, as loans in the corporates have to be refinanced, that will increasingly hit corporate profits. And, you just can't invest in new projects at these prices. I've got a graphic actually of a tweet in next. Let me see if I can share this. How can I? I'm going to put this in the chat. Okay, where's the chat? Here we go. Okay, can you see that? So this is an apartment block in Nashville.
Yeah, can't actually see it. Do I click on something? Oh yeah, I can see it now.
Click on the chat.
Okay.
So an apartment block in Nashville.
Okay.
And it cost 186 million to construct. Yeah. Now, if that had been financed at 8%, then the math doesn't work. Basically, that would equate to $1,800 a month per unit in interest expense. Yeah.
Yeah.
So those sort of developments were only possible when interest rates were much lower. And so the thing is, the longer interest rates stay at these levels, risk assets of all kinds, not just have to reprice materially lower. And we haven't done that yet, is my thought, basically.
Yeah.
You can't have it both ways.
Yeah, my thought is that making sure that the nominal income side keeps up. So they're injecting money through the fiscal deficit and fiscal spending, And I think that's all part of the plan to make sure that the debt is not onerous, so it shrinks away the debt gradually,
Well, the thing is, I just don't think you can.
4%.
Yeah, the thing is, I just don't think you can, Muscle, because the trouble is that if you try and inflate away the debt, you get exactly the problem you're getting now, in that what essentially is happening is that the Fed has stopped raising rates, but the market has kept raising them. Okay, so the interest rate, the headline interest rate is unchanged, but rates in the market are keeping on rising, as though the market has lost faith in the Fed. And people talk about how the markets lose. So if banks were to, so the central bank were to try and let inflation rip to allow the debt to be inflated away, what you're seeing now is exactly what would happen. So they'd try and keep interest rates lower than they should be, but the market would let market rates, the 5-year and 10-year, just keep on rising, and that would destroy the economy. When the existing stock of debt, which is enormous, needed to be refinanced.
I think that's more or less what's happening. People are cottoning on to this nominal income side being because they can just, with GDP, whatever the private sector does, they can just inject more on the fiscal side to make up that number, to keep it at a certain level, So, I mean, I think that's what Ray Dalio said when he said, we're in an era of a beautiful deleveraging where the private sector is all over indebted and the public sector has to step in and basically create inflation while the private sector's deflating, so I think that's pretty much true, from what we've seen develop.
Well, I'm suspicious of the size of the US deficit and the way it's increased so much over the last 6 months. There's something going on there I don't quite understand. So we'll just have to see, what happens. But I really think that, actually, I think October is a crucial month, because if, I'm right in saying that there's lots of deferred taxes that should have been filed in April and were deferred to October, then October should see a big tightening in the size of the fiscal deficit. If we don't see that, it looks like you might be right.
Okay, well, something to watch for then, isn't it?
Well, yeah, absolutely. And, that's the thing. We're very close to October now. We're almost into the fourth quarter.
So
great. We have a few more joiners. Rogue, do you want to just get going?
Yeah, sure. So that was an excellent discussion on the bond markets there, spilling over into the general economics, which is a great prelude to where we're beginning. And thanks everyone for joining the Portfolio Matters and Rogue Trader Discord chat. So to start with, we'll just discuss the general markets, and then we can ask. We've actually got two good opinions there from two different interpretations from Keith and from Muscle Riot. So to start with, here's the S&P 500. Now, can you see that okay?
I've lost your voice feed, Rogue.
Can you see that okay?
Yeah, I can see that.
Yeah,
I can see it. Yeah.
Okay, so I've switched to a new computer because my old computer blew up the other week.
Right. Okay.
And this seems to be a bit slow in responding, but let's hope. So you can see here the the S&P 500, and last time we were actually at the top of this AI bubble, and we're clearly actually falling down from there. Even though technically we're still kind of bullish in terms of those moving averages I've got there, but it does look like it's looking a bit negative.
Actually, can I just come in there, Rogue? And because I'd like to ask everyone what they think about the trends in equity markets, because I've been thinking over the last few days that I think the stock market tends to trend on a daily basis more than it used to. And actually, if you look at the chart, the S&P 500 there, you know, what you notice is it's kind of much more smooth than it used to be. You know, that long kind of grind up and then down. When it goes down for like days in a row. And I'm just wondering whether this is a function of all the bots. You know, so now there are no market makers in the way that there were, 20 years ago. Everything is done by algorithms. And so I'm just wondering whether there's something about algorithmic trading that is making the stock market trend up and down more smoothly than it used to. You don't see the big, 3%-5% drops anymore that you used to. It tends to kind of, instead of doing a sudden 3% drop, it does, 1% a day for 3 days. So, is that just me, or does anyone else have an opinion?
This is a weekly. Each bar is a week on this time scale.
Okay. Right.
I don't know. I'd say compared with 2022, definitely it's smoother. But otherwise, I don't really have an opinion on that, I guess. I haven't really noticed particularly. I seem to remember in 2022, it was a lot more volatile than it is now.
Yeah. Yeah, I just think the volatility is just so low. I suppose essentially what I'm saying is the volatility.
Sorry, if you look down here, we've got the volatility.
Yeah.
And as you can see, the volatility is dropped to nothing.
Extraordinarily low.
Ever since October last year, we've got barely any volatility compared with historically.
So basically, the markets on a day they just don't move very much. They tend to follow yesterday, smoothly down or up. But on talking about the S&P 500, Rogan, obviously, the S&P basically moves global equity markets. I mean, one thing that has mystified me is that, as interest rates rise, so the net present value of equities should fall. And we've shown this chart on the weekly loads of times that the two are just completely disconnected. So as bond yields have risen, equity markets should fall, but they haven't. Now, going forward, we also know that the S&P 500 forward earnings expectations for 2024 about plus 12%. And nothing in the economic data is leading us to expect that you're going to have a rebound in corporate profits next year. So at some stage, you'd have to think that markets reprice lower with revised expectations.
I
think that's happening a little bit now, because as the long-term bonds rise, the 10 years rise, we are getting a sell-off. recently. So yeah, I think you're right about the volatility, though. That is very strange, isn't it?
Yeah.
Because of lower volumes, if people keep money in savings accounts and money market accounts instead.
Well, I think that the trading volumes, actually, that's a very good point. I don't know what trading volumes are actually like. I would suspect they're really high because we have had loads of day trading, and you know that there are all these one-day options which now kind of dominate the options market. All that suggests there's a lot of day trading going on. But, as you know, I fully expect equity markets to tank as the recession starts to bite because, I just fundamentally, I don't think that the economy can live with interest rates at these levels when, that tweet I just showed you about the apartment block in Nashville, so there are lots of apartment blocks being built using funds that were raised when interest rates were much lower, but at these prices, they the whole construction market I just don't think works with interest rates at these levels, and you can certainly see that in the UK where Barratt has cut its developments this year by about 40%, and house prices are falling, and you'd expect to see construction activity dropping monthly, and that's exactly what's happened.
So I've just put up the My Macro dashboard here, and it looks like actually inflation, when you look at quarterly, I like to look at inflation using the CPI number quarterly. And when I do that, when I totted up the last numbers, we are actually looking at only 0.6% inflation for the third quarter, and
Really?
so actually, hello, can you still hear me? Okay.
Yeah.
Okay, so I just got a strange message there on my Windows. So yeah, we're still at we're actually looking at quite decent. I mean, the inflation at this, if it carries on like this, it would have been only 3.9% for the year, and currently it's at about 2.4%. So actually, inflation in the US, still we're talking about, inflation does seem to have pacified.
Yeah, absolutely. You see, this is why I find the bond sale so mystifying. And so actually, if you go into the chat, Rogue, you'll see I posted a slide from this week. And if you use real-time rents instead of CPI shelter, which we know is lagging, then CPI would come in at about 1.5% in the US. So there's really very little inflation. So I really don't see why the bond market is selling off so much. And I realise that oil prices are heading north again, but actually that tends to reduce economic activity medium term. So
yes, so I currently I think that perhaps with GDP as well. The problem is though GDP is currently estimated to be about 5% by according to GDP now. So
yeah, I'm very suspicious of that. If you look at the St. Louis Fed, they estimate that it's about 1.7%.
Right. So overall, though, the question is, so we've got perhaps these indications that inflation, CPI inflation, may be dropping, but the kind of Yeah, so there's contradictory data then there. So you're saying
Well, I
it's
think
probably is quite low GDP growth, but is it low
Well,
enough to kind of enable the Fed to lower interest rates?
no. The trouble is that Fed is going to have to keep interest rates high until they create some slack in the labour market, because the fundamental problem is wage growth is too high. So that's why the market is pricing in higher for longer. But the flip side of that is that implies an economic slowdown, which the equity markets are just not pricing in. I've just posted to the chat, the St. Louis Fed, actually should 1.6, estimates that Q3 GDP growth is around 1.62, that should be percent. Now the Atlanta Fed obviously is much more than that. Let me look up what that is. But I suspect that the Atlanta Fed's too high and the St. Louis Fed's too low. It'll be somewhere between the two. Yeah, no, you're right. It's Atlanta Fed's 4.9.
Yeah, so so generally then, Keith, is your expectation that we're going to get a move into kind of recession area and have a crash of the S&P and the Fed come in and slash interest rates? Is
Yes,
that
that's
your
what I've been
base
expecting
case?
for a year. Yeah, that is my base case, because basically that's what they're trying to do. When you say don't fight the Fed is and the Bank of England are trying to slow the economy. Now, if you look at the UK PMIs, they are absolutely succeeding. There's no question that the UK is slowing down. If you look at the US and you look at the jobs market, it's clear that the US jobs market is slowing. And I'm just going to post into the gone.
I think the difference between the US and the UK is the US is one of the world's top hydrocarbon exporters.
Yeah.
And it also has all of the modern stocks that represent all the modern technologies which help its economy as well. So, it's all the internet stocks and all the FANG stocks basically. So I think those advantages have made the US very resilient.
Well, actually, when I was talking to Muscle Riot a bit earlier, and we were discussing about the big fiscal impulse in the US. Actually, the data looks like it wasn't fiscal. What it looks like is that, and I'm trying to find the chart now, is that there's been an enormous surge in construction activity. I'm posting this now to the chat, that has been associated with semiconductors. So the chart I've just posted to chat shows total manufacturing construction, which has absolutely surged enormously over the last 2 years. But total construction or construction X electronics. And it seems that, during the pandemic, there's a lot of manufacturing was essentially disrupted because the supply chains, and you couldn't get the chips from Taiwan. So there's been huge reshoring activity. And that has meant lots of manufacturing construction. But, how much, I suspect that is a one-off surge, not a continuing process. But clearly the construction sector in the US has been much stronger than you'd expect.
So then we've got so Muscle Riot. What's your kind of general what's your current kind of gut feeling then?
Well, I think inflation comes in waves. We've had one wave where prices went up and people haven't really responded in the labour market. And now we're seeing in the US economy unionization take place. And I believe Joe Biden was actually on the picket lane for the UAW workers' strike, supporting the unions. I think that's going to take off. Okay, so that's going to be another inflationary sort of cost to the economy. So I think that's looking ahead. That's another reason the long-term bonds aren't looking as attractive, at this rate. And there's a lot of onshoring taking place from supply chains, as Keith says, where a lot of industry is coming back to the US through security reasons, whatever reasons, and that is another inflationary impulse, isn't it? So I think we're looking at a future without 2% inflation in sight for more than brief periods, a more volatile inflationary situation going forward. And it seems everyone's on strike in the UK as well. So
that's true.
Trend seems to be happening here.
The thing is, Muscle, I don't disagree with you, but I think where we differ is on the timescale. So what I see inflation collapsing currently. So I think that, if you look at the UK even, we have headline inflation of 6.7%. But actually, if you look at core inflation over the last 3 months, it is in line with pretty much in line with 2%. Yeah. So what I think is going to happen is we will have a recession which will collapse inflation. In the US, there really isn't any inflation. If you look at true-flation in the US, it's about 2.2%. I'll look it up now. But, so people are worried about a resurgence in inflation that really just isn't there yet. Now, where I agree with you is I think medium term that when we have a recovery, then you could see a resurgence in inflation. But fundamentally, do you think much has changed post-pandemic? I mean, pre-pandemic, we were really struggling to get inflation. And has that much changed? I mean, to my mind, the world currently believes it has changed, but the world, one thing you know about markets is they overreact in both directions. And I've got that totally wrong. So I think he's overreacting, and I think he'll overreact to the other side.
Well, the difference pre-pandemic and post-pandemic, I would say, is they printed a lot of money, so the money supply went up a hell of a lot. Now, funny, you can't see deficits in the money supply. As you're right. The money supply M2 is going down, and private activity seems to be. You've got that inflation coming down as the money supply comes down. But with this 6% to 8% deficit that the US, is doing, I believe someone produced a video. I think it was you, Keith, on the Kalecki formula.
Oh, yes, Kalecki formula.
So that basically says if you've got a deficit, then that is private sector savings. So that is going to translate over into income. Government deficits translate over into income. So I think that's playing into it. And that is, sort of transmitting itself through the economy in the future with all these spending programs that they've got booked. So I don't know. It's a complex picture, isn't it? But I would have thought that it would be more or less like Ray Dalio says in his he's got a video on it called "The Beautiful Deleveraging," where the private sector delevers all the debt, the huge debt build-up, and the public sector steps in and it's a once every 70 years sort of economic cycle. They have to do this because, you know, the debt is just run up to such ridiculous levels.
Yeah.
You know, so that's my sort of view. But
well, I think you're going to
be sort of inflated away, sort of sneakily.
Well, I just don't think it can be inflated away because you're getting the problem you have now, where you know you get interest rates rising very fast, and that will kill the economy. And I really believe that will kill the economy because you know people, the markets, the equity markets, seem to believe that these bond yields rising doesn't matter. But you know when the risk-free rate in the US rises by as much as it had, that means all the interest rates in the economy have gone up, and that surely will cause a credit contraction because there's a lot of the investments just are uneconomical, but also you're getting crowding out, so the credit impulse is deeply negative as people take their money out of the banks and put it in government bonds where they get a better yield.
Yeah, I mean, I agree. That is definitely one scenario. And if you look at Japan now, you can see the currency is weakening as they cannot control the bond market. And well, the more control they put on the bond market, the more weak the currency gets, more devalued it gets. And they're caught in a bit of a trap. And I believe the budget is a fifth of it is debt finance, even at these ridiculously low rates. So as the Japanese bond yield goes up, then the financing situation becomes, ridiculous. So totally unaffordable. So that's definitely happening in Japan.
Yeah, actually, this is a really good, interesting conversation, and I think you're absolutely right on that. But that's the path that central banks and governments can go down. Okay, so when you're talking about inflating away the debt, if you look at Japan, what they're doing is they're printing lots of money, but they're intervening in the bond market to stop yields rising because they know that if they let the yields rise, the whole country goes bust. Yeah. So where that shows up, you're suppressing interest rates, but you can't maintain the value of the currency. So the value of the currency is collapsing.
Yeah.
So that you can do. And, if you're talking about a way of inflating away the debt, that works. But notice what they're doing is they're preventing bond yields and interest rates from rising. Because if they allowed bond yields to rise, the whole financial system of the country goes up in a puff of smoke. Yeah. So that could happen. But I don't think we're there yet. I mean, Japan, bear in mind how long Japan has been running this insane monetary experiment. They've been doing it for 30 years. And,
it's incredible, isn't it?
I've been predicting a blow up years ago, but Yeah.
So they had a massive stock market bubble in 1989, and it's been deflation, balance sheet recession, deflation they call it, ever since. And they've just ran up these huge debts to finance this is the deleveraging of the private sector and stepping in with the public sector, and they've reached the end of the road basically now. So it's going to be interesting to see what happens.
Absolutely. No, that was a great book by Richard Koo, if you've read it, actually. The Holy Grail of Macroeconomics. Yeah.
I mean, that's a systemic risk that's lying there, festering in the background. Is the US, the yen carry trade.
Well, I think what Musselwhite and I agree with him are saying is essentially, I just don't think the Japan can really get out of their current situation where they are continually doing QE to limit the rise in bond yields, and as long as they keep on doing QE, expect the yen to keep on falling. And the thing is, actually, Japanese inflation is really low. You know, you're not seeing huge amounts of inflation. What you're seeing is a collapse in the yen.
Yeah, well, the currency is the only safe. That's the only valve, the escape valve for what they're doing. So,
Yeah.
you know, they'll try and intervene to stop at 150 to, you know, that's the level of set apparently, and they don't really want it going to 170 against the dollar. But it doesn't look good, you know, because it's already breached. It's about to breach 150 now, right? This, you know, a couple of days. So we'll see what happens.
Yeah, I just think that the markets everywhere, particularly the bond market, is looking very oversold. I do wonder about the amount of liquidity out there, and you know, we're going to talk about yellow cake in a minute. And the liquidity in the uranium futures market is really low, so it's quite easy to push around. In the case of the bond market, you know, it just looks really oversold. It can get much worse, but these things tend to snap back quite quickly. And do you remember under the Clinton administration, was it the Treasury Secretary, was it James Carville, saying that he wanted to come back as the bond market because the bond market could intimidate anyone? And what we're seeing now is the bond market having a total fit about the size of the US fiscal deficit. And on Musselwhite's point, you know, the fiscal deficit looks like totally unsustainable. Will they actually do something about it?
Well, yeah, I mean, if you look ahead at the Office of Budget Responsibilities forecast the fiscal deficit going forward, it is sort of 6%, 8% deficits going forward all the time, you know. So that's another reason that bonds are selling off, isn't it? You know, so that's I think they might intervene, you know, again, they might relax QT and try and manipulate bonds lower, but you know.
I think they will at some stage, but not now, because this rather suits them, is the bottom line.
Yeah.
They need to get some slack in the jobs market, and you know, higher rates, you know, helps them do that. So they won't intervene now. Where they'll intervene is only if they manage to provoke a recession. And I think they will, because they said they're going to. They're going to keep interest rates higher until they get an effect. And I'm sure they will. And the other thing I'd say is that I think all the Western economies, but particularly the US, is increasingly market orientated. So it's everything actually depends on the S&P 500. You know, the S&P 500, the level of the Dow, and you know, it equates to people's wealth and also to their sense of well-being. And you know, as long as the S&P 500 is going up, everyone feels great. If the Fed can actually get the S&P 500 down, I think that you know, perceptions, etc., will change, and you know, they'll get the kind of recession thereafter, or the slowdown thereafter. We can but wait and see. But you know, higher bond yields, you know, the market currently is acting like they don't have an effect. Well, apart from in the last few days, I think they do.
So,
yeah, well, you know, we're going to see what happens. But I think it might be another thing that might be supporting is more income to labour as a share of the three factors of production. You know, so these huge profits to capital have been going on for such a long time, and labour can't even afford to raise a family, you know, or buy a house, or you know. So I think it might be that Labour, in combination with the unions or wherever, are going to have a resurgence and start taking a bigger share of national income. So I think it's sort of engineered as well by the act.
The thing is, Muscle, honestly, I just don't know. about that. You know, we'll just have to see what happens. You're completely right about the share of the economy with split between capital and labour and how it's all gone to capital over the last 30 years. But I think, honestly, the reason for that is globalization. And in the case of, let's say, the UAW workers, they're going on strike at the car plants in the US. You know, the car plants can just move jobs and move production to Mexico. So I wonder how, you know, compare the UAW is demanding a 40% pay rise in the next 4 years. You know, I just think Ford and GM will just say, no, we'll just move more jobs to Mexico.
Yeah, I think it's worse than that because they want a 4-day week. So it's actually, it's a 70% pay rise. But, we'll see what happens with negotiation. But there seems to be, like with Biden on the picket line there seems to be a sort of push for unionization, you know, even from those political classes, you know. So we'll see.
Yeah.
You're right. You're absolutely right. But, you know, these companies can just move to Mexico and wherever, Brazil.
Yeah. I really just don't think they'll give in. I mean, I was speaking to a US fund manager last week, and he was saying that actually, if you look at inventories in the US car retailers, inventories have been rising. So actually, the strike kind of suits them because they could do with cutting production. So, you know, we'll just have to wait and see.
Yeah.
Anyway, Rogue, do you want to get going?
Well, we are. We're just we were still discussing the S&P 500, but
well,
I was just going to follow on by that excellent point though by just mentioning about AI, because all of these jobs that people are arguing over pay rises are the same jobs that are under threat once AI starts to find its way into the workplace.
You see, I'm skeptical about AI. Not that I think medium term it won't have a great effect, but generally new technologies take about 20 years to properly bed in.
But I mean, I was just hearing what Muscle Wright was saying about the Joe Biden stepping in to the picket lines, and then now I'm thinking, well, what is this future we're moving into here? Is it modern monetary theory and socialism, or you know what's the what's going to give here? What will be the outcome here? Because you can't have well, do you have excessive money printing, but use technology to mean that actually to have the productivity without people having to work? Or do you have the do you curtail globalism to turn the clock back? Or, you know, what are the scenarios here?
Well, it's pretty much always, like even in the 70s, there's massive technological innovations, you know, happening all the time. So I don't think it's more the monetary and the fiscal sort of political side that determines the rate of inflation. I think, you know, productivity is going to, I mean, with AI, it's real, okay, and there will be plenty of job, not much more productivity out of the workforce, but that will happen over years, and it, you know, it can't beat the money they printed, and now it's declining. Obviously, the rate of money growth is declining. That sort of determines inflation, you know. So in the short and medium term, so and then productivity is a long-term thing. So those currents of productivity, like building roads in the 40s and 50s, I mean, just roads are just tremendously productive, aren't they? More productive than sort of databases and things like that. So these things happen all the time, but what matters is the political and economic macro setup. Long term, the productivity matters, but in the medium sort of term, it's the political and macro environment.
So we're kind of in quite volatile times, and then to close off the first section on the S&P, things had started to get almost a bit complacent actually recently, but actually when we discuss all these matters, and then when you actually look at the how the S&P 500's been declining in the last 2 weeks, we are in a dangerous moment at the moment. Is that kind of everyone? Does everyone kind of agree on that?
Yes.
Yeah, I mean, a lot of people are putting it down to the same situation that occurred in 1987, where the bond market was going up and the yield on the stock market was massively underneath the yield on the bond market, and there was a crash,
Yes.
of 20%.
Absolutely. At some stage, the two have to come back into line. Now, it could be that the equity markets crash, or it could be that bond yields collapse. But at some stage, those two have to come back into line, because investors can get a dividend yield, or they can get a yield on an index-linked gilt or bond, and currently the two are just totally out of whack.
And
Right.
is that right? Am I right in saying that then that's in a nowhere to hide situation, because you can't invest in bonds or in stocks, because if the yields are going up, the bonds are going down as well?
Okay.
Well, you can invest in short-term instruments, can't you? So you're talking about the longer-term bonds when you try and value the stock market. So if you value a stock, it'll be on a longer-term basis, and then you add a bit of risk premium. You look at the risk-free rate on 10-year Treasury, and then you discount the stock to its intrinsic value based on that. Okay, so that's why the bond market going up, it has a direct effect on the stock market going down, or should do anyway.
Yes.
So the current yield on the S&P is 2.3% maybe, or even less.
Yeah.
So on a 10-year Treasury, you get 4.63%.
But the value of the bonds goes down, though. If the yield goes up on your bonds you're holding, the value goes down. That's where I was coming from.
Yeah, but if you hold maturity, you get it all back. It's 100%, isn't it?
Yeah.
No,
actually, sorry, could I just interrupt? There's a really interesting chat. We were talking about AI, and so Joe, would you mind coming on? And because Joe says he's been working with AI for the past year, and he thinks the timeline will be a lot closer than 20 years. Now, actually, I think he's probably right, because I think technological adoption is getting faster. But just want to explain a bit about what you've been doing and why you think that.
Sure. So for some context, I work for a company called Kainos. I think Rogue Trader, I think you covered it many years ago. I think that's how I originally found you.
Yes.
Yes. So I can't really go into exactly what I've been doing because it's commercially sensitive. But speaking generally, it's to do with. So I'm a security engineer. So I secure software and cloud environments, that kind of thing. So it's about making our processes more efficient and automating a lot of it. So where we would have, where you would find a security vulnerability, create a ticket, wait for some developer to then pick that up. It's about how we can then automate that instead. And rather than thinking about it in terms of how can we replace staff, we're thinking about more how we can increase productivity and how we can reach more customers and how we can do things faster. So I don't necessarily think that jobs will go immediately.
So do you think that in the past year, AI has actually made a material difference to your company?
Yeah, so it's not just security we're looking at. Every business unit within the company. So we do digital transformation mainly for the UK government, and cloud migrations and that kind of thing for sort of corporate customers. And then we also have, we're also a massive partner of Workday, the HR and planning tool. But yeah, we've definitely seen internally within the security capability massive improvements in AI, and with our speed and being able to, where things where we would have needed other parts of the business to come in, we've been able to do ourselves using AI. And even
Well, Jed, so I've got a question for you, because I mean, I have only a very rudimentary knowledge of AI, but the few times I've interacted with it, what it doesn't give you the truth. It doesn't give you an objective, correct answer.
Yeah.
It gives you a plausible answer. Yeah. And so, for example, somebody got one of these AI chat GPT to do a summary of one of my weekly videos, and it was plausible gobbledygook. So how do you know that, when you send AI to do something, that it's giving you a correct answer rather than just a plausible one?
So if you use ChatGPT as an example, it's very good, but it's also very limited. So you're more having a conversation with it. So somebody has asked, here's some data from a Portfolio Matters slide. Can you summarize it for me? Yeah. Whereas the way we would do it is actually take all of your previous slide decks and feed it into the AI and go, this is how Keith creates the slide decks. And then it would produce it for you. In a similar writing style, similar layout, similar, this is the format of it. And it would do it that way. So the more context you're able to give it, the better it becomes, and the more limited scope it has.
Yeah. Okay. So what I'm taking away from this conversation is that companies who work in the technology space are finding AI very useful.
Oh, it's totally transformative. You've got Google Copilot; it'll code for you. You just tell it what code to produce, and it knows vast amounts of code, so it can just fill in the code. So it's massively productive.
Right.
Although the caveat I would put there is that the quality of the code would be maybe a sort of graduate or junior developer level. When you start getting into more complex things, it needs a lot of guidance from a real developer, to the point where it would actually be more efficient to just do the thing yourself. So I don't think those kind of code generation is quite there.
I think the code generation is quite good. You do have to tweak it, but a lot of things you can do in an hour, which would have took you days and days. So I think it's a big deal, and also for science.
Yes.
Biotechnology. Like one of the first AI companies was actually in the UK called DeepMind, and that modeled a protein, which is almost impossible to do.
Yeah.
They tried it before with 6 PhDs, and it took them something like 10 years to come up with a rough approximation of how a protein folds from the ribosome and the RNA and the instructions that make up proteins. So they've trained with DeepMind. They trained a whole pile of data on proteins, and it could predict how a protein would fold, and that was such a massive thing.
Yeah, I completely understand that, Muscle, but I think that for specialist applications, it clearly works very well. But the question really that I'm trying to work out is how it will transform the economy, how it will be integrated in the economy. And actually, Dan Leeds, could you come on and just explain why you're skeptical? See, Dan Leeds is typing.
Yeah,
if I could use the microphone, I could. Sorry about that.
Yeah, sure.
Yes, the reason I say that is because I've been working in IT for like the last 20 years, and what I see is companies really, really struggling with legacy issues, old technology, databases that don't talk to each other, technology differences from where they've made acquisitions and they've unsuccessfully managed to integrate two bits of the company, and they really are wrestling to a lot of companies are dealing with these huge issues, and in those circumstances, very, very difficult to get the real benefit from these types of advances. So I think whilst the technology I think is here, whether the companies are really able to drive actual benefit from that right now, I'm not so sure.
Very, very interesting. So
It's a massive generalization, so I apologize. I know some companies are better suited than others. I work predominantly in the public sector, so obviously that is not a good example, but I have seen commercial examples where an example would be big banks, people like Barclays. They are wrestling with, anyone who implemented IT in a big way a long time ago is in a bit of a pickle compared to, say, an upstart like Starling Bank, who've done it all on a much more modern technology stack.
Yeah, really interesting. Okay, so
I think
what Joe's saying is
my mind's buzzing with investment ideas here, because it must be interesting to look at AIM stocks and look for companies that are able to integrate modern IT to basically steal market share off the incumbents in that area, perhaps.
You've only got to look at companies like Vodafone and how appalling the integration of the different bits of their business is. It's one of the worst customer experiences I've ever had, and it's because their IT back end is just abysmal, amongst other things. Other mobile providers are available.
I've got a question then for Joe and also Dan Leeds, if you are feel able to or wouldn't mind. Do you have any AI picks or any kind of IT picks in the UK stock market that you could suggest I have a look at?
I'm loath to suggest the one that I hold because it's doing really, really badly. But I'll tell you, I think in terms of the picks and shovels, I think I'm looking at the data centers and things along those lines. So I hold a couple of things. Quadient is an example, just because I can't see why that is not going to be a massive growth space, and Spirent as well in the kind of testing space. But that's had an absolute beating. So I'm loath to recommend that. But have a look.
Name? Sorry, Accordion. Did you say?
So Quadient is a trust, so they just own a load of data centers. It's an investment. The other one will be Spirent Communications. They're very similar to Gamma, I believe, who do a lot of tests. That sort of, it's the things that are required for these things to work well, but they're not specifically AI plays themselves.
Think in the longer term, if I go and look at my local county council, they, the work practices, the work culture, the work procedures, I don't see how you could use AI to, basically cut one's council tax by 75%. But the problem there then is that means making lots of people redundant. But really, with AI, surely a lot of those jobs, public sector jobs, could basically be are no longer necessary.
Yeah.
And then
I think sorry, Rogue, carry on.
Oh, sorry, just one add-on then. Think about the tube. Think about how irritating it is how the unions completely close the London Tube every year or so, and how much money the tube drivers get. Again, there with AI, there's not really there is going to come a point in the next 50 years where you're not going to need tube drivers anymore. And then on the one hand, you've got the argument, great, that's going to cut everyone's rail fares. But then on the other hand, we have this problem here that we won't there won't be enough jobs for the population. So that's this kind of issue we have here, perhaps with AI. But sorry,
on that, the employment front. I mean, I find this really odd that people are talking about, AI and technology causing unemployment. Because if I posted the chart of total US full-time employment, and we're having this discussion when unemployment is at a 20-year low. In the Eurozone, it's an all-time low. In the US, it's a massive lows. There's just no sign that technology is leading to lots of job losses. I mean, everywhere you go, I'd say there's a lack of people in service area orientated jobs. If you try and get hold of your bank or whatever, I think there's loads of I fail to see every technology has caused some job losses, but then created jobs in other areas.
I think the panic sets in when the jobs are lost in the sort of more well-to-do sectors. I think that's what's panicking people about AI. It's not the service jobs that are going; it's the the very good jobs.
Well, I mean, the thing is, in the case of you're talking about AI improving coding. I mean, the thing is, there's I think we're going to need more, coders going forward in whatever happens. It's like Jevons law about energy. So as the price comes down, people use more of it. So I think a lot of as AI reduces the cost of a lot of things, we'll just consume more of it. So there'll be more, more people working in those sort of jobs.
Yeah, 100%. It's from the days of the spinning Jenny. Any productivity just means things are cheaper, living standards rise, and there's more jobs. I just don't see this doom mongering about AI. I don't see any reason for it to be valid at all.
So
yes, I love this.
So I need to say positive. I need to be more positive.
I think the reference to the spinning Jenny marks us all as having done history in about the early 80s when the Industrial Revolution was part of the O-level syllabus. Anyway,
that's where my politics are from.
Well, okay, that was an amazing discussion on AI, and thanks a lot there. Thanks especially for Dan Leeds and also Joe for coming in there and giving us their specialist knowledge on there. Really appreciated. So what I think I'll do is I'll go straight on to Yellow Cake then.
Great.
Right. So, okay. So Yellow Cake. So Yellow Cake are a way to invest directly into the uranium oxide commodity, or that's the uranium triuranium octoxide actually, which is the form of uranium when it's first processed into this kind of yellow powder, which is what's then used for nuclear reactors. So Yellow Cake are listed on the London Stock Exchange, ticker symbol YCA.L, and so because Yellow Cake owed £90 million worth of Yellow Cake, which is worth about 1.2 billion, and when I last did that calculation anyway, 1.2 billion. And so because of this, you can invest in Yellow Cake to speculate on the uranium spot price. And so Yellow Cake, they actually they buy their Yellow Cake off they can buy it off anyone they like, but they've got a supply contract with Kazatomprom, and then this gets once it's delivered, it's stored in their facilities in France and in Canada, and so these are secure facilities. So you can rely on the assets that this company say they have, and they've got here. So here they IPO'd in 2019 and raised 200 million, and then the blue bars here, they represent uranium they store, and the red bars cash. So as you can see, they've used capital raises throughout the years to substantially increase the uranium they hold. This actually is only updated to 2023, so their last annual report, which was actually calendar year, I think that's March of 2023. As all the data's, but it's at the moment there, the blue bar will be quite a bit higher now. But this to show you how they've been quite successful in raising a substantial amount of money, and that they now own well over £1 billion of yellow cake that's safely stored. And what they do is their share price should trade obviously according to their NAV, and actually currently they're about a 5%. By the way, there's this brilliant website which I'm just loading up now. Okay. So you can, okay, so my internet's really slow. So while I wait for that to so I'll come back to that. So anyway, they're currently, when I last looked, they're at 6% discount to NAV. But what they can do is, if they start trading below NAV, then they can buy back shares. And in the past, they were so actually this year, they were at some points a 10% discount to NAV. And so this financial year, and so they did a share buyback, and then they're essentially getting their uranium at a 10% discount. And then also when they're at a premium to NAV, they can sell shares and then use that money to buy more uranium. And so that way they do act like a ETF. So I've got internet problems here. Oh, here it is. Here it is. So there's this website. I'll post the link in the when I post this video on my YouTube channel. I'll post the link. But this guy, who's from the London South East Yellow Cake discussion forum, he actually maintains this beautiful web link page where you can see what the premium or discount to NAV yellow cake is. So okay, so anyway, so it has typically yellow cake has typically mirrored the spot price. It only generally recently it's only been perhaps 5% plus or minus. So of the NAV. So okay, I'm now going to go on to the historical uranium price, and of course, in 1973 there was a oil crisis, funnily enough, which was the prelude to them building lots of nuclear reactors. And I just mention that because we're in a bit of a energy crisis now, and So there was a bubble. The green line here is inflation adjusted, whereas the blue line is nominal numbers. And as you can see, the price of uranium really did spike in the 70s because there was all this construction going on of reactors. However, it then kind of became really unfashionable. And then we also had the 3 Mile Island accident and Chernobyl. And then we went for a 20-year period of extremely suppressed prices where quite simply there was far too much uranium being produced. And then actually though, eventually it got to a point where the mines just weren't producing any uranium anymore. And then a couple of key mines, they had floods, the MacArthur River and then the Cigar Lake in Canada. So these were at the time the biggest mines in the world, and they flooded. And then we had this really extreme price spike in uranium in 2007. Now, apparently there was also some hedge fund activity, but still it does seem extreme. And of course, a lot of people now are pointing to this and saying, a lot of the uranium nuts, the uranium bugs, you have gold bugs and then you have uranium bugs. Well, they're pointing to this and saying this is going to happen again. However, that bubble popped, and we went through a good 10 years bear market in uranium. And then around 2017 time, we was in this situation where uranium was still hated by all the politicians and all the by the general public, and governments felt it didn't want to touch uranium with a barge pole. But basically the mines were not actually producing enough uranium that were actually being used. And the reason why is because everyone thought uranium was dead. The uranium miners were just utilities were just using their stockpiles and not really worrying too much about ever having to have a shortage of uranium. However, we've had this bull market from 2016, and the main reasons are we do still have this undersupply of uranium, which I'll show you later. Now, all of a sudden, rather than being unfashionable, it's the coolest thing ever. All of a sudden, you've got even Greta Thunberg supporting nuclear power, and a lot of the energy crisis. Because there's a lot of this net zero stroke energy crisis political lobby that's dominated politics in recent years, and this same lobby is totally on board with nuclear power because they've kind of realized, and governments have realized, that you can't achieve net zero without nuclear power. So all of a sudden, nuclear power is really fashionable rather than being hated. And then there's the Sprott Uranium Trust, is this kind of hedge fund that was set up, or ETF that was set up a few years ago, and they started buying substantial amounts of uranium on the spot market. So that added another little boost. And then, of course, the war in Russia, because as you can see on this slide, actually 50% of all the uranium in the world is mined in Kazakhstan or Uzbekistan. And it's not possible, nor will it be possible for many years, for these countries to export their uranium to the rest of the world without going through Russia. And it currently leaves the port of St. Petersburg. As of now, the uranium from these countries that goes to the rest of the world. So there are other routes, but they're going to take a long time to set up at any volume. And they're also very problematic because you can see Kazakhstan's landlocked because it's surrounded by China, Iran, so yeah. So the war with Ukraine and Russia, the world governments have still allow export of uranium from Russia, but obviously there's a lot of concern that could end at some point. So so this has then led to this bull market. So I'll first have a quick look at the yellow cake price and just tell you my story. And so I invested in yellow cake back in 2020, and actually at that time as well, yellow cake was trading at a 20% discount to NAV, and then we've been in this a bull market really ever since. And then just in the last couple of weeks, it's really shot up. And so incidentally, these spikes here, that was when Sprott came in and bought, and both these. So here, Sprott bought up 25% of the entire spot market over a period of say 6 months. So that caused this kind of temporary blip. And then here we had the Russia invasion caused this pump, but then that didn't actually stop exports of uranium, and then from Russia. But then Sprott came in and soaked up 23% of the entire spot market over the period of a few months. So that caused this spike. But then these were kind of artificial, temporary spikes caused by Sprott. But the general trend, if you take those out, there's like there's been a definite bull trend. So for me, I'm at my end game because now I'm thinking, right, when do I sell? And so that's why it was good to have another good look at uranium to help me with that. And kind of my kind of general feeling is that this long-term trend is definitely where I'll sell, definitely, absolutely, as like a fallback stop loss. It acts as a trailing stop loss, really, as far as I'm concerned. But I also want to sell at least half at some point in the near future. So I'm watching this ramp up now, and as soon as I think it's jagging back, I'll sell half, and then reassess kind of thing as well. But I'm definitely in my end game. So let's get rid of this screen. Yeah, every time I move a screen, by the way, my computer really struggles with that. However, it's not all blown up yet, so let's keep going. So here's the spot price, and so I think the problem with, rather than look at actually the yellow cake price, I'm looking at the spot price because it's lower noise, and the price of the yellow cake should actually just be, this is more important. You could have monkeying around, could send the yellow cake price, traders or whatever could send it down 20%, but really this is what's more important. And for me, when you zoom out like this, it's actually like a orderly repricing. It's not really so dramatic. And so, and here I've got my when I bought, and then with the 20% discount. But then here you can see this acts as a great trailing stop loss for me, and I'm now looking to sell half as soon as this. I can have like I mean, I still don't know, maybe like a $5 to $10 stop loss or something, and then when that gets broken, sell half. But I'm now basically looking to sell, but trying to be a bit cautious in case there's like a big moonshot again, obviously. But at the same time, I don't need to be. I can sell as well with some cushion, because at the end of the day, it's really, I've got to look at this as an investment where I'm in the end game now, not not having to rely on a big pump or anything to have done okay. So what I've done is, because of the nature of that, it's all kind of quite easy for me. But it's good to go into the supply and demand dynamics of uranium. But before I go into that, does anyone have any comments or questions or criticisms of my approach or strategy, stop losses or anything?
No, you've done well though. I've just got one question about yellow cake. So, is it a closed-end fund or an open-ended fund?
Definitely a closed-end fund.
Right. Okay. So Okay. So, what is the end game for yellow cake? Will it just hold this? Yeah, if it's a closed-end fund, that implies it just holds this yellow cake forever.
Yes.
Then
they just hold on to the uranium, and that's it. Now, actually, that dovetails perfectly into the next bit, which I okay, so yeah, so I've got here their balance sheet, and you can see that they've got 84 million in cash. Now, okay, this is end of year 2023, end of financial year 2023. So it's not updated to now, but as of there, to prove the point, they've got 84 million in cash. They only spend 7 million a year on running costs. So they could just sit on if you look at their assets are essentially all just the uranium they hold, and then cash. They have no debt. So essentially all this company is this uranium that they hold. And they could, if they wanted to, just hold onto that uranium for a decade, given their current running costs. And actually, one thing that I was worried about with them is how much are their running costs? Are you basically just paying for the directors' salaries at a bad price? But actually, when you look at their running costs, they're only 0.6% of their total assets. So that's a fair, if you look at them as if you look at that as an ETF, you're only paying a 0.6% management charge. So while I'm on this screen, on this spreadsheet, I've got their shareholder breakdown, and this is their current shareholding, and actually about half their shareholders are retail investors, which is quite unusual, and I don't know if that's a good thing or a bad thing. But there's a lot of kind of retail excitement, maybe, of uranium, and what I've always thought is, for many years, uranium was always trading at a 10% discount to NAV, and I was always thinking, when it's at a 30% premium to NAV, maybe that's the time to sell. Now, so I'll talk about the supply and demand. So the uranium market, when you buy yellow cake, you're actually investing on the spot market. But the uranium market basically has reactors all around the world that demand uranium, is the mainstay of all the uranium demand. And then you have the miners supplying them. And however, you also have the spot market. So if the reactors can't get what they want from the miners, they can nip into the spot market. But there's all these other sources as well that can dip in or out of the spot market. Now, what's interesting is when we look at the here, I've got the spot trading volume and the contract volume from the miners, and you see that actually historically there was subdued long-term trading volume, and this has been interpreted by experts that I watch on YouTube, that the reactors were basically, they were so used to being able to pick up cheap uranium on the spot market from all the secondary supply that they were very complacent with the miners and basically were buying them sparingly off the miners. When they buy off the miners, it tends to be a 3 to 10 year contract, so it's a long-term contract. So they're buying uranium now for in 3 years' time and onwards. And the reactors actually have their own inventories, which are probably, they could be as much as the total demand in a year or more. But they do have their own inventories that they can use if there's a shortfall. But it gets to a point where they can't forever drain their inventories. They've got to start giving themselves a safe margin to know that they've got uranium to fuel their reactors for the next decade. And anyway, looking at the spot market, you can see how the spot purchases in 2021 and 2022 were substantial volumes of the entire spot trading market, explaining those pumps that I showed earlier. But then otherwise, the spot trading volume is now actually becoming really thin. So as of August, it was only 31 million pounds of uranium. So that's half of the entire of last year. And so this is where we start to wonder if the supply from secondary markets drying up, and this can explain why the price of uranium has been going up. So in terms of reactor demand, I had a look at the the World Nuclear Association. Sorry, I'm just looking for my list of sources here. So I used the the World Nuclear Association, and then there was also the Atomic Energy Agency. So the NEA and the International Atomic Energy Agency as well. And you can go online, and there's apps, there's loads of information online. It's kind of a bit ropey. It tends to be not updated. There's kind of lots of information, but not much up to date to the year information, I'd say. But what I can say, my general take anyway, is that although everyone all around the world are building nuclear reactors, because it takes 10 to 15 years to build one, it's a real slow ramp up. So actually, the demand isn't going to, when we look at this here, the demand isn't going to increase all that quickly in the coming few years, for sure. You know, it's more like a 10-year or in 10 years or 20 years, it could double, but that's decades away. And here we've got the World Nuclear Association data, where you see that the current mining, you can see how the amount of uranium being mined has been reducing. And actually, it's only 3/4 of the demand. So as of now, only 3/4 of reactor demand is met by mining supply, with the rest being either from inventory drawdowns or spot market. And so I've got this graph here, which I got from the World Nuclear Association and also the NEA. And here you see the bars at the bottom, they're mining supply. And then these bars here include mining supply if every mine that could potentially be developed was developed at $60 per pound. And then you've got this line here in the middle, that's the base case of reactor demand. And then you've got the best case up there and the worst case for reactor demand. So you can see that at the moment we are in this shortfall of 25%, where all the mining supply is only 75% of reactor demand. And so this explains to me why the price of uranium is going up, because the spot market's been drying up and there's like a shortfall, and for whatever reason their inventory reliance has reduced. So it's a kind of a very simple, actually, kind of supply and demand dynamic. But as of 2025, in a few years' time, the mining supply should go up, and so there is this period where actually, you know, you could see the uranium price go, you know, it could go up this year and next year, but then you've got to be wary of this. However, then in the long term, then it's bullish in the long term. So me, I want to, I'm in my end game now, but I'll probably set aside a bit, and then in a few years' time, put a proportion of my portfolio back in uranium as a long term bet. But there, be wary that there seems to be the supply problem looks to be resolvable in a couple of years' time. There is, however, though, I'll go back to the question mark over Kazakhstan. So currently half the world's uranium comes from Kazakhstan or Uzbekistan. So, you know, that could be, that could perhaps pull a rug over, that could pour water over the idea of us having enough uranium in the next couple of years. But so yeah, so I've got here the spot market and the long-term market. So that's this data that I was showing you, which is also you know, which is the difference between the you know, the mining supply and the spot market. And what's interesting is that historically, while we was in this massive bear market, the spot price, the long-term price followed the spot price down. So this is because the utilities could always just buy spot price uranium at bargain basement prices. So it was like a buyer's market as far as the miners were concerned. And so you see the long-term contracting price follow the spot price. But what's interesting is we've seen that reverse. Pardon me. We seem to have seen that reverse just lately. And we're in this situation perhaps where the spot price has dried up. And so it's the spot price is now leading the, but you can certainly see anyway this change in behavior, apparent change in behavior, and I kind of try to explain that on the fly there, but I'm not sure how good explanation that was. But anyway, what is for sure is that the
can I just come in there actually? So logically, if you look at those two charts logically, then you would kind of expect that long-term prices would be higher than the spot price, because presumably you're locking in some expectation for, you know, inflation leading to uranium prices in the future being higher. So yeah, that chart is consistent with the long-term price being, you know, the spot price plus a premium.
Yes, thanks. So I think you've helped me understand this now as I was doing that on the fly. You're right. So obviously you're going to have to pay a bit more if in a normal market you'll have to pay more for the long term than off the spot. But what happened was that because the spot was so cheap, because there was oversupply on the spot market, for reasons that I'll go into maybe in a bit. But there was, for example, we had military grade uranium being turned into I think it's called MOX, but basically being turned into material that was then dumped on the used in reactors. So that was and then you had like huge stockpiles built up that were being drawn down of civil stockpiles. So yeah, so in this period here, the spot price was cheaper because that spot market was flooded with uranium no one wanted. And so although yes, utilities would have to pay a higher price for the long-term contract, they basically were also buying it off the spot market at giveaway prices, and so that meant that the spot prices was falling continuously, and the long contract price was following the spot market down over a long period of time. And then we finally got to a point now where, conversely, all of a sudden spot price is challenging the long-term price, because all of a sudden the spot market's all dried up, and so because there's just a massive shortage of short-term uranium, then that's led to the spot
actually
market.
another way to look at another way to look at that is that the futures market is no longer pricing in a premium for the future. And actually, can you move on to the next slide? One down from so slide number 9, actually.
So I don't know which one. This one?
Yeah, next one, number 9. There you are, number 8. Yeah, that one.
Yeah.
And you know, this is why, in my books. So this is a really good chart from this is from Kazatomprom, and it's like from 2020. And you know, now the spot price is 65.
Yes, it's up here.
So you know, basically, pretty much every uranium mine in the world is profitable. And I've done a quick search on Google for uranium mine reopening 2023, and there are loads of them. You know, Namibia alone has got 3 which are going to come back online at these prices. You know, Utah, Arizona, Canada, SA actually is not South Africa; it's South Australia. But so you know, it's not surprised to me that the long-term price is no longer at a premium of the spot, because they can see that in future all these mines are going to reopen. And you know, the chart you showed previously of the expected supply over the years, you know, I think you want to be taking advantage of this spike, which could get much you know, the spot price could go much higher. But you know, within the next couple of years, you're going to get a flood of supply, which will kill the price again.
Yeah, the only thing being though there is that wouldn't the price go down though of the but the long term's actually been going up, not going down. So I see what you say. It should go down to be lower than spot.
Well, the thing is when does this end? 2022. You know, we're now in 2023. I don't know. You know, what's it done since then? Because you haven't got the latest spot price.
But we can actually, I can get the long term and spot price. So that's a very good point, because that's some really interesting data that we can. So I think the Cameco website, it might be quicker for you to get it actually because of my low tech IT. But if you go on the Cameco website, I think they have on their front page the spot and long-term price. I'm going on the Numerco website.
Right. Actually, they don't have. Okay. Yeah, they do have uranium price. Here we go. Right. Okay. I'm going to post this to the chat. And you're right. It is still the long-term price is trading in line with spot. So I've just posted that to the chat.
Great.
So basically, the future is. So what you're saying is that the future is neutral. It's neither in contango or backwardation compared to the current price.
Yeah. So the
interesting.
So there's but you raise a very good point though of kind of don't rush to the assumption that because you see that trend, like I think I said, the spot price leading the the long-term price, but it might also be things like considerations of long-term supply as well, which could. So you can't. So what you're kind of saying is there could be like a spike where if it could be a short-term shortage, in which case, if it's a short-term shortage, then you can't really point at that data and then say, look, we're in a long-term bull run.
Yeah.
So so when I go back here to this chart, I think what we have established is that currently there's a shortage of uranium.
Yeah.
And there's kind of question marks over supply from Kazakhstan and Uzbekistan as well, which has added to the pressure. And the spot market seems to have dried up as well. And so that does give a simple explanation for why the price of uranium has been going up. Now, when I looked into the secondary supplies, these are the civil stockpiles, which we see there's huge stockpiles here. There's then depleted uranium. So this is all the uranium that's already been used in the past. That uranium could actually be recycled, but at a cost. So although that's not really relevant now, it does mean that and I don't know what that price is, but if the uranium price did reach a certain level, I don't know if that's $200 or $400, but it would there's a large amount of material here that would then be a ceiling on the price because it'd become economically viable to recycle the depleted uranium. Now then there's also military stockpiles which are enough to cover 7 times the world's mining supply, according to my wonky data. That is, don't take all these numbers with a pinch of salt, and then there's also underfeeding, which is where you basically save money by you save uranium by underfeeding it into your when you make the fuel rods or the the nuclear fuel assemblies, but then you get some leftover uranium. But the point is that there are all these other undercurrents that can affect the spot price, and there's no vision at all really about what's going on here. So although it's like a thin market, things could be going one way or other, and so it's according to the World Nuclear Association, etc. However, the secondary supply isn't expected to increase above the current very small number of only 22 million pounds in the next 10 years. But it is important to note that there are undercurrents here that could be going on in the background, and you can't really know about. And then on top of that, there's the complexity of the nuclear fuel cycle as well. So when the power stations buy uranium, it gets stored as uranium, but then it gets converted to enriched uranium, and then gets fabricated into the fuel assemblies. So the utilities actually own the uranium through each of these steps, but things can go on in these different steps that could then affect the uranium price as well. So actually, Russia has a hideously large percentage of the fuel assembly and the conversion market. So that as well, I think, may have contributed to these spikes. But the point is that, again, there's these unknowns. You can't rely on just the supply and demand, and so it's worth bearing that in mind that there's lots of these other factors that could come in that could upset the market beyond just the supply and demand. So yeah, so that really completes my run through of yellow cake, and I guess now I can open up to any questions.
Well, just to give my halfpenny's worth, well, thank you very much for doing that. But to me, the key chart was the one of supply and demand in the next few years. And yeah, right now it's tight, and retail are piling into a illiquid and small market, causing the price to spike. And absolutely, play that spike. But it seems to me that it's clear that within the next couple of years, the market will come back into balance and the price will fall again. So I think it's a short-term speculation, and you're do well to kind of stick to your strategy of when it kind of goes above the the top tram line to halve your position.
Yeah, I mean, this is yeah, it's very difficult to trade, and I'm not really a trader by nature, but I'm certainly so I won't want I want to be careful not to say exactly what what I am sure of is that I'm using the here, so I'll just open this up. So if I can open this slide, I'm definitely using the bottom of the channel as a trailing stop loss. And I'm just my plan is normally when stuff goes parabolic, which this hasn't actually. Like I say, to me, this is still fairly controlled actually, but in danger of going parabolic. But what I tend to do is I'll sell half and then sell half again. Is how but I think it's all like a psychological trick for every individual's got their own trick for what works best with their own psychology. But for me, I plan to, as soon as this starts to waver, this current run, I'll probably sell half and then sell half again. But the best case for me would be for it just to stay in this channel for a year, would be great, but we'll see.
Yeah. Well, the one thing I think that, I've taken away from the last few years is that every spike doesn't last. If you think about what's happened in markets over the last few years, spikes down in the oil price or every other commodity, reverse spikes up. We've covered the extraordinary price spikes in rhodium and palladium, and they're all reverse, and you play the upside by all means, but when it spikes, at some stage you've got to get out.
Yeah, I mean, I'd say it's unlikely I'd be investing in them now anyway, I'd say.
Yeah,
but it's all very easy to say that, but I think, yeah, I hate investing in things once they're going, and I should hazard that. Does anyone else in the chat have any questions about the yellow cake?
Well, I thought it was a great, amazing presentation because you've got such a detailed amount of information in there. And you've also got a yellow cake video from earlier, which I did watch, and it's got the same sort of information in. I was just wondering if you've looked at the other companies, because I think we're going to have a nuclear building program worldwide for the green infrastructure stuff. So I was just wondering if you've looked at anything else outside of yellow cake.
Yes.
To do with
and the thing is there, yeah, it's worth a look at them, but unfortunately I feel like I've missed my chance. But the best company is Cameco.
Yeah,
it's a Canadian company, and they're actually the second biggest miner in the world of uranium after Kazatomprom. But they've actually this year bought out Westinghouse. I believe it was Westinghouse. Anyway, pardon me. So Cameco bought out Westinghouse, who are the US largest builder of nuclear reactors and nuclear fuel fabricators. And so it's a huge deal, actually. So Cameco now, they're the number 2 uranium miner in the world. Plus, they are the de facto premier builder of nuclear reactors for the US. So Cameco's definitely right there. The only problem is for me, I mean, their share price, I don't know, maybe Keith, you could get the share price up with my rubbish internet. Sorry.
Kazatomprom.
No, Cameco.
CCJ's the ticker, I think.
Yeah, Cameco. So the share price though has absolutely been going up like a rocket for years. So I kind of worry that I've missed my chance. The other one in the UK, Rolls-Royce, thanks a lot, Keith. So here's Cameco, and I don't know, they're not that badly. They are from 2020. They might not be stupidly repriced, but I'd have to have a look at them. But
12 times sales and a P of 250, near enough. So yeah, pretty highly valued. Yeah.
A comment from PHS that Westinghouse destroyed Toshiba due to cost overruns, and that's a very good point, because that is actually interesting. That's one little thought I had about Westinghouse, and particularly Cameco takeover, is that the problem is it takes the Americans so long to build. And you see Rolls-Royce. Now I had a look at Rolls-Royce a few months ago, and they were barely going. Well, you could make an argument that their balance sheet was highly stressed and maybe a basket case. And then what's happened is they've had lots of. I caught some of the news on them, but I think their sales have improved on some of their things. I believe, but I know that they've been making a big thing of nuclear power, that they're going to be building small modular nuclear reactors. So, however, when I looked at it, I think it was at the beginning of this year, they were a long way off from building their first reactor. So I was I'm a bit kind of dubious of Rolls-Royce. I haven't looked at them for ages, but it's interesting how well they've been doing.
Yeah, so it's a general turnaround story. I'm with you. I mean, the thing is, I really like the idea of these small modular nuclear reactors, but it'd be nice if they got the funding to actually build one. And the trouble with, as PHS has pointed out, the trouble with all these nuclear reactors, the costs always overrun. And I like the idea that they're going to build these in factories and they're going to build them efficiently, but the first few could well have some teething problems, cost overruns, and it would be. I think it's better to wait until they're actually delivered some, frankly.
Are there any other European engineers of nuclear reactors, apart from EDF, which PHS has just mentioned? I believe Siemens, they've got a division that builds nuclear reactors, but I haven't really looked into it.
The French have got URANIUM.
Right.
Now, I don't know exactly what URANIUM do, but I think they might be. Yeah, so lots of tales of hazard here because that's an interesting one. The thing is with that, there's two ways of looking at that though, Dan Leeds. And I've actually watched a couple of videos on the abandoned Russian portable nuclear power stations, but they actually I was looking the other day actually at the IL. There's this Russian tank called I think the T10 or something, which was a huge tank, and it actually was used to so they could have a mobile nuclear reactor. So they had 3 tanks. One was the reactor, one was the control systems, one was the water, these turbines and whatever. And it was possible to actually drive to a remote part of Russia and set up the 3 tanks would then be they'd build around them. So once they built the reactor, it would be static, but it was actually possible to fit a nuclear power station onto 3 tanks. So and so on the one hand, that is dodgy as hell, but of course the Soviets don't really care about people's health.
Yeah.
But it does show that a responsible government, company, or even business could build small nuclear reactors fairly fairly reasonably, I think. If the Russians can do it in the 70s, surely a private company could do it.
Well, I don't think that the safety standards, it's all about safety standards in the West, and the fact the Soviets could do it cheaply, I think, says absolutely nothing at all about the prices we can do it at now. I mean, thank you for Dan Leeds 1980. That I'm going to watch that. That sounds absolutely frightening, these abandoned atomic lighthouses. No, I think the thing about nuclear is everyone's worried about nuclear waste, but there have been very, very few deaths from nuclear waste. And as I posted on the Discord ages ago, every energy system has risks attached. And actually, if you look up the world's largest disaster caused by an energy system, it's actually a dam bursting in China under the communists, which killed around between 25,000 and 250,000 people. I mean, every energy system has dangers attached. You know, Fukushima, I think, killed one person from cancer. So I completely agree we should go nuclear. But that doesn't mean necessarily it's easy to make money out of, particularly on building the nuclear reactors.
Yeah, I think that for me, it's the same as with defence stocks. I feel like I've missed a chance. I've missed a chance, and so now I wouldn't want to go in because the market's priced in so much as that. You know, and I like to. I try to only invest when the general market isn't excited about something. I hate going in when the market is excited already about something.
Yeah, well, I'm with you, Rogue, but actually the people who make really good money are the ones who follow the memes, you know.
Yeah, but
once
that's a
the
different
trend started,
style.
they follow.
That's a different style. That's like the trader style.
Yeah.
And maybe that's why I'm rogue trader, because I'm not actually a trader. I'm a investor more, or like to think myself as. But yeah, I really, I try to. I don't like. Well, personally, I always seem to lose out when I jump on a trend.
No, absolutely. Well, actually, I'd quite like to wrap it up there, if you don't mind.
Yeah, I think it's a good time to wrap up now.
But thank you all for watching and participating. I thought it was a really good session, actually. I thought we had a good chat, and I've learned something about AI. Thank you very much. Thank you very much to Rogue, who's done all the hard work. And I think we're aiming to do it once a month, aren't we, Rogue?
Yes.
So
we've got one.
The next one. Yeah, when is the next one?
The beginning of November, and then one in beginning of December, I believe.
November. So the next one will be on the 1st of November.
Yes, yeah. Yeah, maybe it would be good to look at sectors, or try to think about what are the sectors that are out of fashion but which could be a good investment moving forward, or something like that. And that could build on what we were talking about earlier when we were discussing the markets earlier, and whether we're going to go into
well, honestly, I think in a month's time we'll know, for better or for worse. So, I think we'll have a very interesting chat then, because as we were talking earlier with Musselwhite, on the 16th of October, I think we start to get an answer about, the size of the US fiscal deficit, and whether it was, structural or just because of deferred taxation, which will come in late. So watch this space. And normally October is quite an exciting month. So, I think 1st of November could be an interesting chat.
Yeah, well, fantastic session there, Rogue. I've learned a lot. So, thanks for putting it together.
Great.
Most welcome. Thanks very much for joining us again.
Yeah.
You really helped us
everyone
out.
who participated.
Thanks bye everyone.
Right. Okay. Cheers. Thanks everyone.
Please read the disclaimer. Remember that prices can go down as well as up.